Hello, welcome to Business Live. Coming up in this bulletin, International Monetary Fund warns growth for Ghana this year will suffer due to the current global tariff war.
So we can anticipate that there will be much lower bilateral trade under either the reference scenario or the April 9 between the US and China. And that is weighing down on global trade growth. This is weighing down on global trade generally.
We will be engaging a financial economist on the back of this revelation, plus bring you live updates from Washington, D.C. For the ongoing IMF World Bank Springs meetings. Also in this bulletin, Parliament's ranking member on Economic and Development Committee, Kojo Oponkruma, insists government's decision to halt proposed program extension talks showed that things were on track even before the fourth review.
The fund is of the view that the economy is progressing, and that's why we have passed this particular assessment, and that's why we're going to be able to access the next 370.
Plus, Ghana aims to refine about 900,000 barrels of oil per day with the establishment of 3 world-class refineries in the Western region.
3 refineries, they're going to produce about 300,000 barrels
per day.
So
each refinery
day. Yes.
is going to produce
so we are looking at
900,000
a day.
We have details of this and more for you. Please stay on. Thanks so much for your time. I am Pius Kojobaka, and looking at our stories. Ghana's economic growth for this year will suffer, while inflation could go up marginally. That's according to the new IMF Economic Outlook report. George Yafe has more from Washington, D.C.
IMF Economic Director speaking at a news conference here at the IMF headquarters noted that this is due to Ghana's marginal exposure to the U.S. market and how that could impact on demand for its product and also export to that country.
This is an environment of enormous uncertainty, increased volatility, and that, I think, is something that will dominate for many of the emerging markets. So when we're looking at our assessment, we are actually downgrading the emerging market economies for 2025 and 2026. Most of them, some of them may, as I mentioned, benefit, but overall as a group they're downgraded. While because they're also very plugged into the global supply chains, the uncertainty is leading to a pause in investment and activity, and they're going to suffer from the decline in demand for the products coming from the tariffs.
The director has also been talking about how this could affect inflation in countries like Ghana.
Our assessment is that it's going to be negative. We have a box in our report that looks at the long-term impact of the tariffs if they're maintained, and it is negative for all regions, just like the short-term impact. So we're seeing a negative impact in the short term, in the medium term, in the long term. Again, there are nuances. Some countries might benefit depending on the particular configuration of tariffs, might benefit from some trade diversion, but the broad picture is it's negative for the outlook. Now, and I will end with that, our forecast for 2025 is slightly higher than OBR's forecast. Some of this has to do with some of the underlying monetary policy assumptions. For the UK, the bank, our assumptions for this year is that there are going to be 4 cuts through the year. 1 cut already happened. We expect 3 more.
He have noted that this could be mixed because of how oil prices are dropping on the international market and how countries like Ghana could also benefit from this development.
There are nuances. Some countries might benefit depending on the particular configuration of tariffs, might benefit from some trade diversion, but the broad picture is it's negative for the outlook. Global trade is going to be significantly affected. The particular configuration of trade, which bilateral trade flows are going to be affected versus others, that will depend on the final landscape in terms of tariffs. So we can anticipate that there will be much lower bilateral trade under either the reference scenario or the April 9 between the US and China. And that is weighing down on global trade growth. This is weighing down on global trade generally.
He, however, noted that the development presents some challenges for developing countries like Ghana to come up with some strong fiscal reforms to help mitigate the impact of these developments on the global economy on Ghana.
Now, the interesting development is, what does it mean for emerging markets? And you're right to point out that in the past, when dollar would strengthen, that would not necessarily be good news for emerging markets because they have dollar-denominated debts, so that increases their liabilities and the pressure on them to service those debts, and that can lead to some tightening of financial conditions. So we are not seeing that right now, and so that's a plus. The flip side of this is, of course, the appreciation of some of these emerging markets' currencies means that they are also losing a little bit on the competitiveness side. So there's maybe something that is a bit easier on the financial conditions, something that is not as easy on the trade side.
From the headquarters of the IMF building in Washington, D.C., this is George Jaffe reporting for Joy Business.
I want to stay a while longer at Washington, D.C. because the ranking member on Parliament's Economic and Development Committee, Kojo Nkrumah, has indicated that government's decision to suspend extension talks with the IMF showed that the program was indeed on track. Finance Minister Dr. Kasiela Tuforsen recently announced that government has no plans of entering discussions with the fund to extend the program when it ends in May 2026. But speaking to Joy Business's George Jaffe in Washington, D.C., Mr. Nkrumah noted that the development showed that the fund's program was indeed on track.
Expecting the Minister of Finance to ask for a program extension. It was the NDC themselves, when they came to power, who started announcing that they will be looking at ways of reviewing or extending the program. And then you'll recall that the fund flatly said, no, they are not looking towards an extension. And now you have the government side saying that they are also not looking for an extension. So we were not even expecting in the first place. It's their own, may I say, rhetoric that has brought them around this circle. Number two, the issues that we raised on the back of the last review were the fact that if you look at the various parameters, the Ghanaian economy is recovering. It was, again, the administration that attempted to undermine that through this 49 billion commitments that they tried to introduce. And you'll notice that the fund in their statement even do not agree with the outturns that they claim if they want to admit these commitments. We have said that if the fund goes ahead to do that, it will be out of touch with their own definitions, the definitions under the Technical Memorandum of Understanding in the ECF, and we don't expect them to do that. But be that as it may, the fund is of the view that the economy is progressing, and that's why we have passed this particular assessment, and that's why we're going to be able to access the next 370.
All right, so let's unpack all these issues as we've been joined via Zoom by financial economist Professor Lord Mensah for a conversation on these matters. Thanks so much, sir, for agreeing to speak to us on Business Live. Now, first off, the IMF is warning economic growth for this year will suffer, while inflation could also go up marginally due to the current global tariff war. Now, how concerning is this revelation?
Yes, it is of a concern. Because if you look at the global dynamics and the interconnectivity when it comes to, international trade, clearly, if the big shots, within the global space get affected, it tends to spill over to smaller countries like, Ghana. So having, Donald Trump being some way, somehow inconsistent when it comes to, this tariff policy, of course, it is expected that it will affect, bilateral trades with the U.S. But then also, the impact will depend on, the net trade flow. I mean, if I say the net trade flow, I'm looking at, the difference between, the export that various countries do to the U.S. and then also the import that they do from the U.S. I mean, if you take Ghana, for instance, as an example, in 2023, we did very well by exporting more to the U.S. than importing from the U.S. So with that, case, if you look at the impact of the 10% tariffs, it may not have that much of impact compared to, other countries that have focused on the U.S. as their main, trade destination. Ghana has done well when it comes to the diversification of its, trade, export. For instance, if you rank in terms of the data of volumes of export, clearly you'll come to appreciate that the U.S. is around on the 7th, position when it comes to our export volumes to the US. So dealing with the Switzerland, dealing with China and all those, I think Ghana stand, a position of some way, somehow, not affected that much, from these tariffs. But then Ghana may not be affected. But then you remember Ghana is trading with China. If China has a problem with the US and it turns up that, the economic activity within China goes down, obviously it's going to affect consumption levels of, the Chinese, and it may affect, Ghana. So the network and then the way the flow of, goods and services has been over the years, once one, network breakdown as a result of tariffs increase, as a result of restrictions, it tends to affect, all the countries involved in the trade network. But then, if you look at China, they have started negotiating with South Asia. Recently, you can see, they've started negotiating with the GCC countries, and clearly they want to open up, their market. So tend to move away from too much focus on the US and then look at elsewhere. But then, of course, once you are breaking into new market, it's going to be kind of a challenge because the market is not going to accept, the product, immediately. But, let's see how things go. But then we should expect that, these things are going to affect global economy.
All right, conclude that for me.
Yeah, for Ghana, looking at inflation, we may, inherit some inflation increase from, these problems through the exchange rate channels. And that is why we may have to look at how we can tame this down to ensure that we have some local stability. And if I say local stability, we have to ensure that things that we can produce in Ghana, through our budget policies and other things, we enhance them, especially in the agriculture sector. I don't want a situation where we'll back out. We allocate, sums of money for agriculture and we end up not seeing anything, and then we'll be looking out for importation. It will end up affecting, our currency. So we need to work hard to have some kind of local, stability.
We need to work hard, you say. But when you take a careful look at the reports they've issued, you realize that the issue about the country's economic growth is not only a concern to them, but as well a drop in donor funding. And I'm wondering how significant that is when you take a careful look at the 2025 budget. There have been provisions for grants, etc.
Yes, especially when, deficit cannot be financed from the, global financial market like the Eurobond market and all those. Then we have to look at, grant as an alternative. So if, countries are going to suffer, in terms of their trade, they will not be able to generate much buffers to support other countries. So we should expect that, grant will be affected duly.
Professor Mensah, let me pick your thoughts on this. Interestingly, Fish Solutions is projecting that Ghana will be among the least affected countries in sub-Saharan Africa to be hit by the U.S. tariffs, war, etc. But how do we reconcile these two projections from the IMF and, of course, Fish Solutions we are learning?
Well, IMF is looking at global, impact, and for which you cannot take Ghana out. But like I mentioned earlier, it depends on the trade volumes that specific countries do have with, the U.S. And I mentioned earlier that in 2023, we did very well by exporting more to the U.S. than importing. In such a case, we may not necessarily be affected. And then also, countries may have, their trade exports overly concentrated with the U.S. And by then it can affect them more. But for Ghana, if we look at the diversity when it comes to our export destinations, clearly we tend to have a bit of, respite, because if you rank, trade volumes, as I mentioned earlier, from the 2023 data, the U.S. export is just about on the seventh, that's about 1.7 billion. But then other countries, we are exporting 3 billion and all those to those countries. So clearly, our impact is minimal based on one, we have diversity when it comes to our export destinations. And then two, the net, trade flow between Ghana and the US is, very, very positive.
I truly appreciate your time, Professor Lord Mensah, a financial economist, for speaking to us here on Business Life. And we'll stay a while longer on the IMF, of course, this matters arising. And Associate Professor of Finance at Andrews University, Williams Pipra, says government must convince the International Monetary Fund that it will engage in rigorous structural reforms and implement the Public Financial Management Act. According to him, this will send a positive signal to the fund about the country's preparedness to meet all necessary IMF conditions.
So both Ghana and IMF, we know because of the change of government, we wouldn't have known that probably we overspent more than we programmed in the IMF program, plan. This is to give some confidence to IMF that yes, something happened. We are ready to identify the areas and to address them. We really want to confirm that the expenses that have been booked are really legit, and then we have a plan to do a proper optimized allocation of resources to pay for them. Leading to this means that we Ghana as a country, we did not really conform to our own Public Financial Management Act. So one major area that needs the structural reform is how to make sure that the Public Financial Management Act is implemented, and this implementation will be able to achieve them when all new appointed heads for government institutions and SOEs, ministers are aware and they have been trained. This is the structure we are following in our budget execution, and you need to be able to ensure some form of transparency in what we do, especially with a give-mix payment system. The government must make sure that they follow on that structure.
This is still Business Life. We have more for you after this break. Hello again. The African Trade and Economic Outlook Report 2025 has revealed that Ghana's fiscal and external balances will remain under strain in 2025, reflecting a broader trend across Africa. The report attributes the persistence of external imbalances to chronic fiscal deficits, low domestic savings, and underdeveloped financial markets. More from Winston Taki.
Ghana's macroeconomic environment in 2025 continues to be shaped by long-standing structural constraints reflected in widening fiscal deficit and a narrowing current account surplus. Despite notable recovery effort and ongoing reform under the IMF-supported program, the country's external balance remains under pressure, mirroring a broader continental trend outlined in the African Trade and Economic Outlook Report 2025. According to Ghana's 2025 national budget, the government's projects total revenue and grant at 223.8 billion Ghana cedis against an expenditure target of 269.1 billion, resulting in a fiscal deficit of 45.3 billion Ghana cedis, representing 3.1% of GDP. This persistent fiscal gap underscores a structural challenge the country has faced for decades, a mismatch between revenue mobilization and expenditure demands. Finance Minister Dr. Kesela Tuforsen has described the situation as a call for shock therapy, advocating significant expenditure cuts and the scrapping of some taxes to bring relief to the economy.
One of our lead stories, Ghana is aiming to be the preferred destination for petroleum refineries in Africa, with a plan to refine about 900,000 barrels of oil per day. Now, this was revealed by the Chief Executive of Petroleum Hub Development Corporation, Dr. Tony Obeng. The ambitious initiative will see the creation of a petroleum hub with 3 world-class refineries, each with a capacity to process about 300,000 barrels of oil per day. Speaking in an interview on the Super Morning Show, Dr. Obeng explained that the successful establishment of the hub will leverage the African Continental Free Trade Area to serve several African countries drilling hydrocarbons.
We are looking at various, I think the 3 refineries, they're going to produce about 300,000 barrels
per day.
So
each refinery
day. Yes.
Is going to produce
so we are looking at
900,000
a day.
Our current crude oil production is less than 200,000 barrels per day. And we know that the businesses drilling oil within our waters also have contractual agreements. So what strategy are we going to use to ensure that we get the crude to supply these places to enable us to produce?
Okay, let me just clarify that government is not putting up the refineries.
Yes.
So we have done some feasibility studies to know that it is feasible to do that here. But it will be for the private entities who want to do that and who would be satisfied that building a refinery will be their money's worth. Now, the advantage Ghana has is its closeness to everywhere. Africa is discovering a lot of fossil fuels. We are discovering a lot of hydrocarbons. Not too long ago, Namibia discovered some significant quantity of oil. Now, the idea is not to only obligate our internal production, but also to make it possible for people to bring crude from anywhere to refine. It's like the earlier example I gave. I spoke about the fact that Switzerland doesn't produce gold, yet Switzerland refines a lot of gold. So you create that situation for people to come and do that.
Government will engage high-powered officials of gold fields to ensure smooth takeover of the diamond mine in the Western region. This is what we've picked up from persons with knowledge of the planned takeover of the mine. More in the following Business Desk report.
Joy Business understands that this meeting that government will be holding with officials of gold fields will involve some senior officials, or call them top-level executives, from the group head office in South Africa. Information that Joy Business is picking up, at least for now, suggests that government could grant the request for gold fields for more time before they finally hand over all their assets on the mine to the state. This is because government want to avoid any gaps that may come up if Goldfields should totally pack out. Sources say there has been fresh communication from government to Goldfields to keep their machines running on the diamond mine for now. The workers have also been told to still keep working on the mine. The Minister for Lands and Natural Resources, Emmanuel Amakufi-Boa, in an engagement last week announced that government will take over as the new owners of the diamond mine. However, the outcome of this high-powered meeting today, April 22, 2025, could change things in terms of whether Goldfields could be given at most a year in terms of still managing the mine before government finally takes over. Well, for now, fingers crossed.
And that's our package by way of Business Life. I am Pius Kojo Baka. We have more stories for you when you log on to myjoyonline.com/business. There you go. IMF1's global growth forecast will drop to 2.8% in 2025 due to trade uncertainties. Also on that portal, cedi to remain stable this week. $1 equals 15 cedis 98 pesos. Also on that portal, you have DBG's 500 million cedis to bolster Greek and economic sector. That's according to the CEO. And of course, Ghana exceeds IMF reserve target ahead of program completion date. We have more stories when you log on to myjoyonline.com/business. Always a delight serving you. See you soon.